Welcome back. Let's reveal some of the top news stories we've been following this hour. Chinese President Hu Jintao meets Japanese Emperor Akihito again and tours a prestigious Chinese school in Japan. The Olympic torch relay heads to Shantou in South China for its last stop in Guangdong province. China calls on the world to provide aid for cyclone-ravaged Myanmar. And Hezbollah government take control of West Beirut on the third day of clashes with government supporters. Well, we're Sue Jones is at the business desk, and the oil prices hit another record high.
Yes, certainly. We will get to that in a moment. But for now, some key figures from within the country. Now, China's producer price index for industrial products rose 8.1% in April year-on-year. This is a record high since 2004. Experts are concerned. They're warning that this surge may have a knock-on effect on the consumer price index. As Chen Lijun explains, this could mean more pressure on rates of inflation.
Influenced by the international market, producer prices for industrial raw materials rose sharply. According to the National Bureau of Statistics, factory gate prices of crude oil surged 37% in April year-on-year, while gasoline was up 10% for the same time period. Producer prices for raw coal jumped about 21%, and those of steel products rose up to 41%. Experts say the rise in the producer prices index, which measures the value of finished products when they leave the factory, may lead to rises in consumer prices. And this is because the cost of industrial goods are linked to the cost of a daily life, such as what people pay for clothes, household appliances, and food, as producers seek to pass on rising costs to consumers.
In April, producer prices for industrial products related to people's daily lives rose by 5.4%. That is rather high. The price of clothing has jumped significantly. The surge may serve to push up the consumer price index.
But experts also point out that China has carried out various measures to curb inflation. These have helped to bring down prices of staple food, such as pork. Analysts are already forecasting a fall in the consumer price index in the second half of the year. Chen Lijun, CCTV.
China is in no rush to make the yuan fully convertible under the capital account. The director of the foreign exchange regulator is warning that uncontrolled capital flow could actually hurt the economy. Instead, Hu Xiaolian is stressing that realizing full convertibility in the capital account should be a gradual process and should correspond to progress in economic development as well as financial reforms. Specifically, Hu Xiaolian says capital convertibility is not advisable without better regulatory frameworks, more mature investors and more efficient macroeconomic controls. She added that China will evolve its own methods and will not be modeling itself entirely on other countries. State-owned investment company, that is China Investment Corporation, says it is keen to pursue long-term benefits and has no intention of hindering economic development in other countries. Chairman Luo Ziwei has stressed that CIC will not act based on short-term gain and is keen to step up transparency over time. China Investment Corporation was set up last September as financial authorities look for better management of the country's soaring huge forex reserves, which stood at more than $1.5 trillion by the end of 2007. And moving on now, U.S. stock markets ended lower on Friday as oil prices soared into uncharted territory and set a record at $126.20 a barrel. U.S. crude futures jumped $2.27 a barrel, closing at $125.96. This is the fifth record high in as many days, and there are a whole spate of reasons for the continued rise. These include geopolitical tensions in Nigeria, Venezuela and Iran, increased oil consumption in emerging nations and a weak American dollar. And not helping matters are investor concerns. They are wondering whether a possible confrontation between the United States and Venezuela could cut exports from the OPEC member. And it's not just the United States and Europe that have been hit hard by surging oil prices. China is feeling the heat as well, as Zheng Junfeng explains in this report.
Experts say the surging oil prices is likely to depress growth in the global economy as well as trigger inflation in some countries, neither of which would help the Chinese economy. For a start, China itself will have to spend more on buying what it needs to refine.
China is a huge oil importer. We import 150 million tons of oil every year. The higher the oil price, the more we have to pay. There is no way around it.
Experts are stressing that the recent price jumps are not due to imbalances in supply and demand. Instead, they are blaming a weakening dollar and geopolitical turbulence.
The U.S. economy is now on the edge of a depression, and the dollar has been weakening for quite a while. Those are the major reasons for oil price increases. The other reason is that some big oil producers have been experiencing domestic or international conflict or have worked out some new policies on oil production or distribution. This have also had their effect on prices. In fact, oil reserves and supplies are sufficient, and there has been no significant rise in demand to drive up prices.
Meanwhile, China has come up with fiscal policies such as tax cuts to companies to counteract the impact of the price hike. Experts are also urging companies to cut energy consumption to lower their costs. Zheng Junfeng, CCTV.
Well, that's it from me. Time to hand the program back to Liang Hu.
Okay, thanks. Still to come on NewsHour.